I believe we're finally at the start of a more sustainable bull market. It's been 2 years of stocks under pressure in general. If you take a look at high growth stocks, in February it'll be 3 years that they've peaked. Now I believe not only are the underlying conditions improving to support a more sustained stock market rally, I think if you look back at historical precedent, we can really see that we have gone through a very typical speculative bubble during the COVID bull market. And we've now gone through the very normal, lengthy process where that bubble unwinds. Whether we're at the absolute bottom, which I think we have. I think we've passed the worst of market weakness. But in general, looking at the bigger picture, we spend so much time focused on what stock to buy and where to buy. In reality, if you could actually just capture the sizable uptrends in the market, that would allow you to outperform the vast majority of fund managers out there. But let's take a look. Let's see what we're talking about here. Now, first off, if you take a look at the NASDAQ 100, it doesn't look like the markets are under all that much pressure. My perspective is there are 7 stocks dominate the NASDAQ 100. The top 7 stocks make up 44% of the index. However, if you look at a more broad-based reading, most stocks are still under significant pressure. And that's really what I'm trying to look at, is when are the majority of stocks going to participate and we're going to get more of a broad-based rally. So I think if you ignore the QQQ for this period of time and to really visualize the kind of speculative bubble that we've gone through during COVID and the aftermath, let's take a look at the ARK Invest Innovation ETF, ARKK. You can clearly see we had this massive run up into the February 2021 top. We progressed sideways, we've broken lower, and we've now fallen 80% in just a little under 2 years. Now, the very, very interesting thing about this is the exact pattern that virtually every speculative bubble will go through and has gone through in history. I mean, you can go back hundreds of years and you can see this, but let's take a look at a few examples of just this past century. So if we take a look at ARK Innovation, but we compare that with the NASDAQ's .com speculative bubble in 2000, you can see the very same exact shape and pattern. We had the very large mania that went into a large peak in March of 2000. We had the initial break lower, we track sideways, and then we fall lower. All in all, after the .com top, the NASDAQ fell 78% in about 2.5 years. So just about similar to the 80% the ARK fell in around 2 years. If we go back a little bit further, let's take a look at gold in 1980. Now, the 1970s was full of inflation, just like kind of what we went through. But back then, President Nixon in 1971 took the US dollar off the gold standard. So gold and the US dollar used to be linked. No more of after 1971. That sent gold prices parabolic, ending really with the big market top in 1980. But you can see gold again follows that very, very similar pattern. It goes pretty much parabolic into a straight up line into early 1980. Peaks, has a hard break. We head sideways as people still think we're heading higher before we break lower, ultimately falling 62% again in 2.5 years, similar to the 2.5 years of .com and the just about 2 years for ARK. Let's go back one more time. Let's go all the way back to 1929. So we had a speculative bubble in stocks just most recently with the ARK Innovation. We had one at .com, and of course the one everyone will still talk about because of the ensuing Great Depression was the 1929 top. And you can see we had, again, the exact same pattern 100 years ago. We have a speculative mania, goes into almost vertical prices. We have a bad initial break. We head sideways before we go into a long, protracted sideways downward decline over 2 years. The Dow Jones in 1929 fell 89%, again, in 2.5 years. So a 2.5 year drop for the Dow in 29, a 2.5 year drop for gold after the 1980 peak, a 2.5 year drop for .com after the .com peak, and we recently went through a little, just under 2 years for that drop in ARK, all of them falling pretty much in the 80 to 90% range. Gold fell a little bit less. Gold is a more stable asset than stocks. It's gold. So we're going through that same pattern, and after what has been a lengthy decline in all of these indexes, even though the Great Depression went on for the 1930s, stocks bottomed in 1932 and put in some sizable rallies. So kind of taking ourselves back from the short day-to-day, action of the market, what stock do we buy, where do we enter, how do we manage risk, taking a look at the big picture, I believe we're on the cusp of something more significant. Now, that brings up a few questions. How do you know if you're wrong, and where do you put your focus? And so typically, if you look at past market cycles and when they bottomed, we can stay a little more recent. We can look, for example, after .com. The best stocks to buy after .com are typically new names. It's not typically the same stocks that dominated in the last cycle. There's always a few that will come back, but the vast majority are new names you haven't heard of, that were stocks that came to market after the bubble burst, but were held down by a bad market. And ultimately, when the bad market passes, these stocks become the next leaders of the next market cycle. So that's really what you want to look at. You want to look at typically new names, new leaders, or at the very least, it needs to be a stock that's having a turnaround play where their underlying business was not damaged by the actual drop in the bear market. Lastly, how do you know you're wrong? This is a very important point because, again, this is big picture stuff. I mean, you can be off by a few months and it can be very painful. So again, my go-to indicator to have a good sense of market direction is looking at 52-week highs versus 52-week lows on the NASDAQ. Very simple. If we have more stocks making 52-week highs than we have making 52-week lows, it's generally a healthy environment. And just passing the simple logic test, forget all the nuances of stocks in the market. If more stocks are making 52-week highs and 52-week lows, there's net buying, there's accumulation going on. And so since the very recent October bottom that we just experienced, you can see as stocks again have become stronger, they're advancing, they're making higher lows rather than breaking down to lower lows. This is happening now on the backdrop of having more 52-week highs and 52-week lows. If you look at this NASDAQ chart, you can see in the lower pane, when you see green bars, that means there's more highs than lows. If you see red bars, that means there's more 52-week lows than 52-week highs. So we've been in this green zone here since the market has put in its bottom. I'm operating from a bullish stance. I've been accumulating stocks. If I were to see more 52-week lows come back into the market, I'll start to work my way more into a risk management mode. But for the time being, this is my big picture view. We're looking at what ARK is doing as a guide for growth stocks in general. I'm not specifically buying ARK Innovation, using that as kind of a big picture view of how high growth stocks have gone through this speculative bubble and where I think we're finally coming out the other end thanks to inflation coming under control. So we'll see what happens going on from here. This is why I love history. I love to look at these parallels, and it's just incredible. Like the old saying goes, the names change, the pockets change, but the market remains, and we keep going through these repetitive cycles. So we'll see what comes next, but very exciting for the first time, and it was been a good period of time of market weakness. It looks like we have things improving. If you enjoyed this video, please like, share, subscribe. You can follow me on Twitter at trader_mcaruso. You can visit me on my website at carusoinsights.com, and we'll be back soon with some more video. Thanks.